Welcome. This is the UAE E-Invoice training for finance and accounting teams, delivered by Slight Consulting. Over the next 22 slides, we will walk you through what e-invoicing means for your finance function, what the UAE law requires, and exactly what your team needs to do differently once the mandate takes effect. We will not ask you to learn XML or chase IT details. We will keep this in finance language. What counts as a valid invoice, what fields you have to get right, how VAT accounting changes, when to issue a credit note, what to archive, and where teams most often slip up. This is internal training designed to take about an hour. Module 1 covers the fundamentals. Module 2 covers the UAE-specific framework, compliance, and workflow. Let's begin with what we want you to leave with. Before we open Module 1, 3 things to expect from this session. First, by the end you should understand the UAE invoice framework end-to-end, who governs it, what the DCTC model is, and how an invoice flows from your ERP through PEPPOL to the FTA without needing a technical background. Second, you will know your compliance responsibilities, which fields are mandatory, what VAT treatment applies, how credit notes work in this new world, and what the archiving rule requires. Third, you will know how this changes your day-to-day, what your AR and AP teams need to do differently, where the common errors hide, and what to verify before go live. Module 1 starts with the foundations, what an invoice is, what e-invoicing is, why governments are mandating it, and the 5 terms you will hear throughout this training. Module 1, E-Invoice Fundamentals. This section sets up the rest of the training, so even if your team thinks they already know what an invoice is, stay with us. We will separate an invoice from a sales receipt, separate e-invoicing from a PDF you email out today, walk through why every major tax authority is moving in this direction, and finish with 5 precise definitions you will see come up again and again throughout this program. For slides, then we move into the UAE-specific framework in Module 2. Let's start with first principles. An invoice is 4 things at once, and confusing those roles is where compliance problems begin. First, it is a legal commercial document, binding under UAE Commercial Transactions Law and the Federal VAT Law. Second, it is a VAT accounting record, simultaneously an output VAT declaration for the supplier and an input VAT recovery document for the buyer. Third, it is an audit trail. The FTA can ask to see any invoice for 5 years. Fourth, it is a business control. It triggers revenue recognition, accounts receivable, accounts payable matching, and downstream reporting. When we move to e-invoicing, all 4 of those roles still apply. The document form changes, but its legal weight and accounting purpose do not. Hold that thought as we look at what e-invoicing actually is on the next slide. E-invoicing is not a PDF sent by email. That is the single most important thing to take from this slide. An e-invoice is a structured XML file. Every field, the supplier TRN, the invoice number, the line item amounts, the VAT, sits in a labeled data element that machines can read directly. It flows end-to-end digitally. The invoice originates in your ERP. Your accredited service provider transmits it across the PEPPOL network to your buyer's ASP, and the FTA receives the data in real time. There is no manual rekeying at any point, and validation happens before delivery, not after. That changes 3 things for your finance team. Errors are caught at issuance rather than at audit. Your buyer's input VAT recovery depends on receiving a valid XML, and your reporting to the FTA is continuous rather than quarterly. Next, we look at why governments are doing this. 3 reasons driving this globally, and they all matter for how you read the UAE rules. First, closing the VAT gap, the difference between VAT owed and VAT collected. Real-time invoice data makes underreporting and false input VAT claims immediately visible. Second, combating invoice fraud, inflated amounts, fictitious suppliers, and duplicate submissions are caught before payment because every invoice is validated by the ASP. Third, digital economy alignment. Over 80 countries already mandate or are rolling out e-invoicing, and the UAE is harmonizing with international PEPPOL standards rather than inventing its own. For your finance team, the practical takeaway is this: the FTA is no longer waiting for quarterly returns to spot issues. Errors get flagged at issuance, and that's exactly why data quality at point of entry becomes your biggest control. Last fundamentals slide next, the 5 terms you will hear throughout this training. 5 terms, defined in finance language. Pint AE, the mandated XML invoice standard, built on PEPPOL BIS Billing 3.0 and UBL 2.1. ASP, your accredited service provider, the gateway that validates, transmits, and reports your invoices. PEPPOL, the international network on which the ASPs exchange invoices. DCTCE, the Decentralized Continuous Transaction Control and Exchange Model, which is the UAE's five-corner architecture for sending invoices to your buyer and the FTA simultaneously. And scenario codes, the labels that tell the FTA whether the invoice is a standard tax invoice, a reverse charge, a zero-rated supply, a self-billing arrangement, and so on. Don't worry about memorizing the codes, your ERP and ASP handle them. But you should know they exist because mapping the wrong scenario is one of the most common errors we will see in Module 2. That closes Module 1. Module 2 is where we get specific to the UAE. Module 2, UAE E-Invoice for Finance. Now we get into the UAE specifics, the legal framework, the document types, the mandatory fields, the flow your invoice takes through the network, the VAT accounting treatment, how to handle credit notes, and what changes in your AR and AP processes. We will close with the readiness checks, the most common errors, the archiving rule, and a final checklist. 14 slides, most are reference material your team will come back to, so this is the section to take notes on. The legal anchor is Ministerial Decision 243 of 2025. It establishes the e-invoicing obligation, names the Ministry of Finance as the standard setter and ASP accreditor, and confirms the Federal Tax Authority as Corner 5, the recipient of all invoice data. Article 3 applies the system to any person conducting business in the UAE regardless of VAT registration status. Mainland, free zone, and foreign entities included. Article 4 carves out limited exclusions. Phase 1 begins in July 2026 for large taxpayers, with broader rollout following. For your team, 2 practical implications. 1, this is not optional, and 2, the compliance perimeter is wider than VAT registration. Being out of scope for VAT does not put you out of scope for e-invoicing. Next, we look at what counts as an invoice document type under this framework. 3 document types you need to recognize. Tax invoice, 12 subtypes, the primary document for taxable supplies, covers everything from a standard B2B sale to reverse charge, zero-rated, deemed, self-billing, and the specialist schemes. Commercial invoice, 1 subtype, used for transactions outside the scope of UAE VAT such as cross-border intercompany flows and going concern transfers. No VAT is charged, but the invoice is still reported for traceability. Credit note, 3 subtypes, used to reverse or amend any of the 13 invoice side documents. That gives 16 scenarios in total. Detailed scenario-by-scenario guidance is in the dedicated scenarios deck. For this training, the key point is recognizing which document type a transaction belongs to. We will spend the next few slides on tax invoice format, mandatory fields, and how the invoice flows through the network. 2 formats inside the tax invoice family. Tax invoice, issued for B2B taxable supplies to a VAT-registered buyer. Must carry supplier and recipient TRN, full line item detail with individual VAT amounts, the supply date, payment terms, and the PINT AE scenario code. This is the document the e-invoicing mandate primarily targets. Simplified invoice, issued to non-registered consumers in retail, hospitality, small transactions. Requires less detail. Supplier TRN, date, description, total, and VAT. No buyer TRN. Threshold rules vary by sector. Your ERP needs to know which format to issue based on the customer master record. Getting this wrong matters. A tax invoice issued to AB2C customer overcollects data. A simplified invoice issued to AB2B customer prevents their input VAT recovery. Next, the specific fields your team must get right on every invoice. The mandatory fields grouped by role. Supplier fields, your legal name and TRN must match FTA records exactly, plus trade name if different, address including emirate, and contact details. Recipient fields, for B2B, customer legal name and TRN. For B2C simplified, name only. For reverse charge and self-billing, both sets carry extra flags. Document fields, invoice number, issue date, supply date, currency, document type, and the PINT AE scenario code. Line items, description, quantity, unit price, VAT rate, VAT amount, and line total. VAT totals, taxable base, VAT amount, total payable, and any reverse charge or zero-rated indicators. Your ERP either generates these natively or via an ASP connector. The ASP validates them on submission. Gaps or mismatches cause immediate rejection. Next, we look at where the invoice goes after submission. 5 steps, 5 corners. Step 1, your ERP, corner 1, transmits the pint AE XML to your ASP, corner 2. The ASP validates the schema, checks the mandatory fields, applies a digital signature, and assigns a unique document identifier. Step 2. Your ASP transmits the validated invoice across the PEPPOL network to your buyer's ASP, corner 3. Step 3. The buyer's ASP delivers it into the buyer's ERP, corner 4. Step 4. In parallel with delivery, the data is reported to the Federal Tax Authority, corner 5. Step 5. Confirmations and any rejection messages flow back to you through the ASP portal. The whole exchange happens in seconds, and your only direct interface is with your own ASP. PEPPOL routing and FTA reporting are handled invisibly. That is the architecture. The next slide explains what your ASP is actually doing for you and where its responsibility stops. What your ASP does, and equally important, what it does not. It validates every invoice against the pint AE schema before transmission, applies the digital signature, routes through PEPPOL, reports to the FTA, and gives you a portal showing transmission status, rejections, and delivery confirmations. What it does not do, and this trips teams up, is correct your data. If a TRN is wrong, a VAT rate is missing, or a mandatory field is absent, the ASP rejects the invoice and returns the error code. The fix happens in your ERP. Your team has to monitor the rejection queue and act on it the same day. Choosing the right ASP matters. It must be MOF accredited, must integrate cleanly with your ERP, and must give you usable monitoring tools. Next, what e-invoicing changes about VAT accounting. 2 things to separate: timing and dependence. Output VAT timing does not change. You still account for output VAT on the earlier of invoice date or payment received. What changes is that the FTA receives your output VAT data in real time, not after the quarter closes. Input VAT does change in a meaningful way. Your buyers can only recover input VAT on invoices issued as pint AE XML through an ASP. A PDF received by email no longer supports input VAT recovery, and that means your customers will demand valid e-invoices from you the moment the mandate applies to them. The tax procedures law continues to require that the supply must actually have taken place and that the invoice must be retained for the archiving period. The accounting entries you already make stay the same. What changes is the form of the source document. Next, credit notes. When to issue a credit note: goods returned, post-invoice pricing errors, agreed post-supply discounts, or a duplicate invoice already transmitted. You cannot use a credit note to cancel an invoice before transmission, only after. What it must contain: a reference to the original invoice number and date, the same scenario code as the original, the reversed VAT amount, and the reason for issuance. The credit note flows through the ASP exactly like an invoice, validated, signed, transmitted to the buyer, reported to the FTA. Your buyer reverses the input VAT they previously claimed. You reverse the output VAT you previously declared. Both sides reconcile automatically because the credit note references the original. The common failure here is issuing a free-text credit note in your ERP that doesn't carry the scenario code. It gets rejected. Configure it once properly. Now, what changes day to day for your AR and AP teams? Concrete process changes. Accounts receivable: you stop emailing PDFs to customers. Your ERP hands the invoice to your ASP, which delivers to your customer system. You monitor the ASP portal daily for delivery confirmations and rejections. Rejected invoices are corrected in the ERP and resubmitted, never patched manually. Accounts payable: you stop receiving PDFs by email for B2B supplies. Your ASP delivers structured invoices straight into your ERP. The matching process runs against structured data, which means three-way match becomes faster and cleaner, but it depends on your master data being right. What does not change? Approval workflows, cost center allocations, payment runs. The shape of your AR and AP function is the same. the inputs and outputs become digital. Next, what to check inside your ERP before go live. 3. Readiness check categories. Data quality. Every customer and supplier master record needs a valid, FTA-verified TRN. Products and services need correct VAT rate classifications. Invoice number sequences must be gap-free. ERP configuration. Confirm the system can generate .ae XML natively or via an ASP connector. Ensure mandatory fields are populated for each document type. Set up scenario codes correctly per transaction pattern. ASP integration. Live, tested in the sandbox, monitored connection, rejection alerts, archiving, and reporting all wired in. We recommend running a sandbox parallel for at least a month before going live. Issue invoices in both your old and new processes, reconcile the outputs, fix the gaps. Next, the errors finance teams make most often so you can avoid them. The 4 errors we see repeatedly. 1. TRN errors. Incorrect, expired, or missing TRNs cause immediate ASP rejection. Maintain a verified TRN master and validate against the FTA directory before entering. 2. Confusing supply date with invoice date. They are often different and both are mandatory. The supply date drives VAT timing and the FTA cares about it. 3. Wrong scenario code, for example coding a reverse charge transaction as standard, which causes a VAT mismatch on the buyer side. 4. Mandatory field gaps, missing recipient TRN, wrong VAT rate, blank line description. Most of these are master data and configuration problems, not real-time judgment calls. Fix them upstream, in your ERP, in your master files, in your scenario mapping, and the day-to-day rejection queue stays small. Next, archiving and the 5-year rule. The legal anchor for archiving is Article 78 of the UAE VAT law. 5 years minimum for tax records, extended to 15 for real estate. MD 243/2025 confirms e-invoice data must be stored inside the UAE under the tax procedures law. What to archive? Both the original .ae XML and the human-readable PDF/A3. The XML is the legal document. The PDF/A3 is for human reference. Most ASPs provide automatic archiving as part of their service, but you must confirm the storage location is UAE resident, that retrieval is auditable, and that the format remains readable for the full retention period. The penalty exposure for missing or unreadable records during an FTA audit is significant. Treat archiving as a finance control, not an IT afterthought. Next, the checklist your team needs to clear before your compliance deadline. 3 blocks of checks before go live. Block 1, ERP and ASP. Your ERP generates valid .ae XML for every document type you issue. ASP connection is live and tested in Sandbox. Mandatory fields are populated for every scenario. Rejection workflow is configured and monitored daily. Block 2, master data and VAT. Your own TRN is confirmed with the FTA. Customer and supplier TRNs are verified and updated. VAT rate classifications are correct against product and service codes. Scenario codes are mapped to your transaction patterns. Block 3, archiving and process. .ae XML and PDF/A3 archive is in place, UAE resident, auditable. Finance team is trained on AR and AP changes. An exception handling SOP is in place for ASP rejections. Sign these off and you are go live ready. 1 slide left, the 3 takeaways from this training. 3 things to leave with. 1. E-invoicing changes what counts as a valid tax invoice. After your compliance deadline, only invoices issued in .ae XML through an MOF-accredited ASP are legally valid B2B tax invoices in the UAE. A PDF will not support your customer's input VAT recovery, and that is a legal change, not just a technical upgrade. 2. Data quality at point of issue is your most critical control. The FTA receives your data in real time. A wrong TRN, a missing supply date, an incorrect VAT rate, they cannot be quietly fixed at month-end anymore. Get them right at issuance through master data, scenario configuration, and ERP discipline. 3. Credit notes, archiving, and rejection handling are finance processes, not IT processes. Treat them as part of your monthly close. Thank you for joining this training. Your notes from this session should be enough to begin the readiness work in your team.